attention to what is happening in the second page. In the second page of the paper, this is the article, but this is the graph. Turn on anything you want so you can get good picture. And it says that things are moving fine. Last time I asked you a question. And the question is, what is volatility? You remember it? Volatility is when things go up and can go down. This says that in November, the market index, Standard & Poor 500, and one stock is going up. We go on further and we see what is happening. And as we see what is happening, we get different pictures and different type of information. And as we go on to the second part of the journal, we want to focus on what is happening in the markets. And I want to see Standard & Poor, that I have it here. I want to see the Standard & Poor in larger time period. So here I see it for the last year. And what I see is a candlestick graph. And I want you to tell me what is a candlestick graph. The information that I have here is in a given time period. For every month, we have the weeks, and it's giving to me what is happening in weekly terms. For the last year, what do you see? Most of the weeks, the market went up or down? Or most of the colors are green or red? Which means that I would like you to know what is the meaning of that particular graph. And the meaning of this particular graph is something very important. It says, if you have a period of time that the opening price and the closing price is such that the closing price is higher than the opening, you compare these two prices when we start and when we finish. If the price goes down, this is the low price, and if the price is going up, this is the upper price that we can have. And we have 4 pieces of information. In the bottom, we can have information about the volume, which means how many stocks were purchased and sold. What is the difference between the red case? Then the opening and the closing have exactly the opposite case, which means here we have a drop of the price. The price may start here, this is the upper, and this is the lower price that we can have throughout a period of time. And that says what is happening in the stock markets. This is what we're going to focus today. What we want also to have in our mind whenever we think about the stock market is what happens in the bond market. And if we want to know what is happening in the bond market, what we like to see is what is happening with the yield curve. And I want you to know what is a yield curve. The yield curve is whatever we get as a reward if we lend money to the federal government and the government borrows money from us for a different time period. The time period may be short term for 1 month or long term for 30 years. What we have here is very important case. And this curve changes all the time. The normal curve is what happened. Oh. The normal curve is what happened last year. This is the normal curve. I take it, I see it here. The normal curve is whenever we have an increase throughout the period. And as that particular case, now let's see how I will do it, or get out of here. This is something else. I think I hit and I got out of my part that I had. Printed version. I go into here. Take this part, I will do control print, I will go into my Word document, here I can write what is the normal curve. The normal curve is as if I have money for longer period, I would get higher reward. But that happens in normal periods. What is happening now? Now I have a flat curve for most of the time, which means if I put my money to the federal government for 1 month or for 3 months or for 6 months or for 1 year or for 2 years, almost over for 3 years, I get exactly the same reward. That means I'm giving you a pressure. What's the pressure I'm giving you? To not give money for longer period of time because you don't know what's going to happen next month. To operate in short term. If I want you to operate in short term, I will give you higher reward if you give me the money for 3 months. Higher reward if you give me your money for 1 year. Higher reward if you give me your money for 30 years. Which means what? I went to the bank on Sunday to deposit something. I look at what is happening there. Citibank says that would give you for $25,000 deposit 1.25 reward for a year. Do you want to put that much money for 1.25%?
No.
Maybe, maybe not. And you have to consider what else. This is secure reward. If you put your money in the stock market, you may get much more, but also you may lose. And based upon what you want between return and risk, you make a choice. And that choice is, what is your attitude towards risk? If I'm a risk taker, and if he is risk averse, then we can have exactly the opposite behavior. I will take the risk and he will go more careful and secure. I may lose or win, and he will certainly win, but he will win less and I may win more, but I may lose more and he may not lose at all. Is this clear? And this is what we are going to discuss mainly today. And we have many options. What are the options? The options is we keep the money in our own business, or we can put the money in someone else's business as investing in a stock market, or we can put the money that someone would like to borrow because it has debt. That could be either government bonds or corporate bonds. And a corporation can get the money either in their bond market if they want to sell their debt, or in their stock market. And there are different types of risks, and we will go and discuss further that case. Now we go to what is risk. And risk is when we look at what is happening in the market. I get out of here, I go to whatever I have, and I look at what is happening in the market. And I want to see what is happening for the last year. From November to November, what is going on? And we have two different ways to look at it. One is for the sub-periods that we have here. We look at the picture and we make instantly a judgment. There are more greens than reds. Therefore, the market is moving up. The next thing I would like to do is I would like to focus on two different graphs, on this particular case and on that particular case. These are moving averages, and I want to know what is average. And if I know what is average, then I would like to say what is a moving average. And a moving average is related with how many days we can take. One is to get the average for 200 days. The year has 365 days, so you can take more or less 2 out of the 3 parts of the year to see what is going on. And the other average is on 65 days, which is a little bit more than 2 months. As you can see, these two lines are different. The line that has shortest period for the moving average moves close to your data. The line that is larger period moves farther down from the data. That gives you a little bit more conservative picture of what is happening. But both of them tell you what is happening with the market. And you see that the market is moving up from the period of July and after. And is moving up from one case and is moving up for the other case. And as it is moving up, it creates expectation that it's better to put your money there, as long as it does not create a risk. But based upon what you want to see, you will see the company that he said to me today, which is AT&T, or the company that the student talked to me last Wednesday, and that's General Electric. So what do you want to do? You want to put your money out of General Electric and into AT&T. Then you sell General Electric stocks, you take probably a loss, you take that money and you go on and you buy AT&T. As a result, what is important is to know how prices are formed. And we said last time that prices are formed based upon what is happening with the demand and the supply. the demand and the supply relates quantities to prices. And we have two forces. There is a demand force. Demand force means what? Demand curve means what? If the price is high, you buy less. If the price is lower, you buy more. And that's the way that we demand things. What do we want to do? We want to buy something at a lower price and keep it so the price would go up. How the price goes up? Based upon what is happening with the demand and the supply. And then I have another force. What's the other force? The other force is the supply. What is the supply? Supply is that if the price is high, you supply more. If the price is low, you supply less. And what is happening? If some people supply a stock or any product, and some people demand a stock or any other product, then whenever you supply and demand, you have an agreement. We call that agreement an equilibrium. What is an equilibrium? Equilibrium says that for this particular price, that is the equilibrium price, the quantities that we demand and the quantities that we supply are equal. What is happening if the price goes up or down? If the price goes higher, then we have a difference between the quantities that we demand and the quantities we supply. And this particular difference is excess supply quantity. Because if the prices are very high, we supply more than we demand. Similarly, if we have a price, this one, price that is a lower price than the equilibrium price, then for that particular case, we have excess demand. Because for the lower price, we demand more than what we supply. So what is happening? The prices go up and down, and as the prices go up and down, we make an adjustment, and eventually we get into the point that we agree. This is how much I will supply, this is how much I will demand, this is the price. How the price goes up or down? The price goes up or down because the demand and the supply can change. How the demand can change? The demand can go higher for the same supply. Then the price moves to this level. Or the supply can go higher, and the price would go to this level. Or the supply would go lower, and the supply would be lower, and the demand is there, and you can have at that equilibrium. Which means that as supply and demand moves up and down, supply moves up, supply moves down. Demand moves up, demand moves down. Why? Because have different expectations. As a result, we change the prices. And as we change the prices, we move the economy, and in that particular case, we move the stock market. Same thing is happening with the bond market. And I want to see what is happening with the rest of the newspaper. I go on and I see what is happening with the rest of my newspaper. Another picture that tells me the same thing. Now we have the two metaphors, bull and bear. Bull means that something that moves up, bear means that something that sleeps. That's why we call the bullish market and the bearish market. What is happening? In the years we have, sometimes the market moves up, sometimes the market moves down. What is happening usually for that particular period? We have more times that the market moves up or more times that the market moves down? Bearish. From 2014 to now, mostly the market moves up or the market moves down? Bearish. The market moves up. And if this is the case, I would like to get out of here and go on to the Wall Street Journal. I got whatever I have in the Wall Street Journal, and I want now to do whatever I did before. I want to go to Yahoo Finance. And as I went to Yahoo Finance, I want to see what he was telling me at the beginning of the class. He said, look at the AT&T stock. I go on, and I want to look at the AT&T stock. AT&T. Is it here?
You have to put an anti.
Hmm?
AT&T. The symbol.
So, what do I have here? As I type, automatically I find out what is the stock that I'm looking at. So, AT&T has an acronym that is T. And as we have what is AT&T, only with T, we get it here. I'll get it in Yahoo. I will get it also in the market case search. I'll put T. And I'll get the AT&T. As I get the AT&T, it tells me in which market AT&T is traded. AT&T is in the New York Stock Exchange. New York Stock Exchange is further down here, the Wall Street. I click it, and I have what is happening with the AT&T. I have it in the Wall Street. I have it also in Yahoo Finance. I have it also in Google Finance. I'll go on and I check it with my cell phone, and I can see what is happening. I get the articles that are usually related to AT&T, and I can be able to see what is going on with my AT&T stock. I go to the company research, and I get a graph. As I see that graph, I see what is happening for the last 5 days. Is the market open today? Not yet. Just started. I don't know what is happening today. That's automatically gave me the last 5 days. If the market was going on for some time, it would stay at the current situation. I will go on to what happened to the last month, 3 months, from the beginning of the year. And what do you see? From the beginning of the year, the price is moving up. That's why he wants to buy AT&T. For 1 year, that goes to the previous November. We have a different story, which means something important. If you change the time horizon, you change the story, because it's a time difference that you have there. So what do you see? You see that last December, we have some decline in the price. But from the beginning of the year, more or less, the price is moving up. How much? the vertical axis tells me how much. And I want always to see things in two different ways. One is I want to see what is happening with respect to dollar change, because that's an important point. But if I want to compare it with another stock, I would like to see what is happening with the percent change. And automatically here, I'll have the percent change. And I want you to be quite careful with what is going on. 10% increase of two different stocks, that one is moving from 100 to 110, and the other is moving from 1,000 to 1,100, have the same percent change. Both of them increase by 10%. But 10% for one stock is $10, 10% for the other stock is $100. And you care about the money, not the percentages. As a result, you need to be able to see what is happening. So what is happening if you look for 1 year? From last year to this year, the stock changes. How much is this? 25%, 30%. You have the change. This is the first picture that you have. If you want to look things for 3 years, you go on and you look for 3 years. If you click it, you go to advanced charting. And I ask you to play around with your advanced charting. If you want to make a candlestick graph, you can make a candlestick graph. And I want all of you to go on and see what is happening. Let's go on for the 6 months. And I want you to see what's happening with the 6 months. Here, you have the moving average. You can edit it. The Wall Street graph that you saw gave you not 50 days, it gave you 65 days. You can go on and you can change it. You can put it 65 days. And you see what's happening with moving average for the 65 days. It gave you also another period, 200. You can put 200 and the graph is going to be different. What does this mean? You take the last 200 periods for the frequency that you have here, and you can control the frequency. What is the frequency here? It's daily. You can be able to go on and change it to weekly. You can be able to go on and change it to monthly. And you can see what's happening month by month. So when the price changed mostly, from August to September, from September and after, the price does not change that much. You can be able to go on and change it back to daily. What do you have here? You have a line graph. You can change the display. What do you want to do? You want to do a candlestick. You have a candlestick daily. Now you go on and you make it in weekly. You can go on and you can make it in monthly. You can go on and you can make it quarterly. And you can see what is happening for that particular period. Everything is relevant. If you want larger period for quarters, you can see what is happening. And what is important is the most recent period is more relevant than the old period. What it happened further in the past is further in the past. What is happening right now is what is important right now. And what do you see? For the last 3 quarters, the stock is going up. Is this only for this stock, or is it because the market goes on? I can go on and I can change the display. I can put the line display. I can go on and I can change the frequency. I can go to a daily frequency. And I can add another case. And if I can get another case, I can be able to have different things here. Is 10 years important, or I want to look for the last 6 months? Or do I want to look for the last 3 months? As I do that, I see things change. The last 3 months, the change is not as big as if I see it for the last 6 months. If I want to see for the last month, or I want to see for the last 5 days. And if I have that, I can be able to do more things with the environment that I have. Now I'm in the Wall Street, right? I go into Yahoo. And as I go into Yahoo, I can see the same information in Yahoo. I'll go for the last 6 months. And I want to go on and see what is happening. And I see the different charts that I have. I see the financial information. I see what is happening with the news, and I get informed of what I want to be able to do. Not much time to do all of that stuff in class. Why do I bother with Yahoo? Because Yahoo allows me to go on and get historical data. And if I get historical data here, I'll take the data for free. And I will have the data of whatever I want to have. I look for the time period. I specify the time period for the last year. I click done and I have the time is for the last year. Today is November 18th. I go back and I get the period to be from November 18th, 18 to November 18th, 2019. I go to the historical prices and I want what is the frequency? Daily. Do I want it daily or do I want it weekly? Here I can have it in weekly period. Now I have less numbers. And I click apply, and automatically things change. And what I want you to do is I want you to download the data. And as I want to download the data, I'm going to do it daily. I want you to do it daily. I want to select the periods for the last 3 months. Daily. Done. Apply. You have automatically with 2 clicks whatever period you want to have. And then you have download. As you download, you have a file here at the bottom. That this particular file, you can have it, put it into your computer. The file is named with the company that you have, and you see the data of that particular stock. This is how easy and how fast you can be able to get your data. From that point on, what is important is to work on your own things with what you would like to do. And you have the information that you need for every day, from open price, high price, low price, close price. Adjusted close price is related to this one, and volume. I want to make graphs. Do you have Excel? You have Excel here. Before you go on, I want to see what is this file, or I want to see what is the acronym of that particular file that you see here. And the acronym for that particular file is a type of a file that keeps a lot of data without spending a lot of memory. It's CSV, a comma file. That means that the way that data are in this particular file are in a particular format, that one part of data is separated with the other with a comma format. If I want to go on and save the file, and I want to save it in the desktop, it gives me here what is the format of the file. And that says that is a comma delimiter file. I don't get into details, but that does not allow me to have a lot of information. Like what? Like graphs and like formulas. I need to change the type of the data that I have to a different file. Because always I get someone in the final exam that does the work but doesn't save it in the right format. And then it says, Professor, I did it. You saw me do it. And I said, yes, but you lost it because you don't pay attention. And I want you to change it to the type of a format that it keeps the most space possible, which is the Excel format, the Excel workbook format. If you change to this format, then you will have another file. You see these two files? You see these two files? They are both Excel files. One is a comma file, the other is Excel workbook file. You see it and you look at it. The way that it looks, you know that things are different. I want you to work with this particular file here. And I want you to make a graph. What graph do I want you to make? I want you to make a candlestick graph. I don't want you to be bothered with the adjusted closing price. And I want to take that and look at the file of what is happening with your data. I want you to insert a graph. And as you want to insert a graph, you can go on and you can pick and choose all type of graphs that you need to have. What kind of graphs we have here? Stock graphs. And as you look at the stock graphs, it gives you several options. And what I want you to do is I want you to use the graph that is related to the type of data that you have. As you see, you have 4 options. One option gives you high, low, and close price. Is this what you have or you have more? I cancel it. I go up here. I do it again. I insert a graph. The graph that I want to do is a stock graph. And the stock graph that I have here, I need to select the graph that it is exactly the same with the options that I have. This graph says it's high, low, and close. Can I use it? No, I have open, high, low, close, and volume. I go to the next part. The next part is open, high, low, and close. Can I use this graph? No. I have volume, and this graph does not put volume there. I go to the other part. volume high, low, close. It's not the right order. I go to this one. Can I use this one? Yes or no? He says yes. Pay attention to the order. The graph has volume, open, high, low, and close. My data have open, high, low, close, and volume. Can I use it? No. Why not? Because the order is not the same. I need to have something with the same order. What do I need to do? I need to change the order in my data. I cannot change how Excel is doing it. I need to change the order of my data. So I cancel it, and I need to change the order. I put here my order. I take this thing out from here, and I paste it here. Now I have the order that is required. What do I need to do? I can go on and select the area that I want to graph. I want to insert a chart. I want that chart to be stock chart, and I can have a graph. This graph here will give me whatever I have. What do I have? For August, that's the period I selected. For August, I have daily information that tells me what is happening with respect to volume. Volume is something that I have here on my left side, and price that is on my right side. And I want to see what is happening in that particular case. I put the title. This is AT&T, and I want to know what is happening for August 24th and 25th. Why don't I have data? What happens here? August 24th and 25th.
Oh, the market is open?
The market is not open. What's happening? It's a weekend. It's Saturday and Sunday. I have data only for the periods that I have data. Now I don't have blue, I don't have green and red. I have white and black. Do I know which days the market dropped down? The black days. So which days the market went down? August 20th, August 21st, August 23rd, August 26th, August 27th. The market went down. Which day the market went down a lot?
23rd.
The 23rd went more down than any other day. Do I have any other indication for the 23rd? About the volume. It's the day that I have the highest trade. What happened that day? How the market goes down? When people buy or when people sell? Mostly sell. But in order to sell, you need someone else to be able to buy. Because if you sell and nobody buys, what is happening? If you want to sell and nobody wants to buy, what is happening?
Drop down price.
What is happening? You want to sell and nobody wants to buy. You drop the price further till someone wants to buy. And if nobody wants to buy and you drop the price so much, the market crashes. And what you see here, you see an indication what is going on. The market has two pieces of information. One is the quantity, the volume, and the other is the price. For the price, you have more information than you have the quality, because it tells you how much the price changed. What is the important to see is the range of the price change. What is the range of the price change? You have two different ranges. You have the range from the opening to the close, or from the opening to the close, and you have the range from the highest to the lowest price. So with 4 points, 4 numbers, you have a conclusion of what happened in one particular period. That particular period can be anything that you want your data to be. Can be a year, can be a date, can be a quarter, can be a month. If you have detailed data, can be a minute, can be an hour, so forth, so on. You take that data, and what I would like you to do is I would like you to go to another site here and have your graph, cut it from here, go and put your graphs here. This way you can have one part of your Excel that you will have your graphs. I go back and I want to deal with your data. And now I want to do something else. I want to take your data and I want to copy all that data and go and paste it in another piece and keep only the closing price. And I want for the AT&T to look what's happening at the closing price. Before I do that, what I would like to do, I would like to format everything that is prices as $1. And I want to take it and see how I will make another graph. This graph is the closing price of the stock. And I see what is happening with the closing price of the stock. I may use it. So what do I want to do? I want to identify what is this stock. This is the AT&T. How is it notified with the letter T? What do I have is what is happening with the closing price of the stock. And here, I want to start playing. Automatically, I got a range from $32 to $40. And I want to be able to make an impression. Can I control the axis? Can I control the axis? What is the lowest price that I have here? 37.72. Can I have 37?
It says 34.
What?
It says 34.
Correct. 34 to 7. And I have a different range. Is this the lowest one? If I put it 35, I will not have that part. This is what I have. This is what I have as a stock. What do I want you to do? Go to home, and from that point on, I would like you to make your graphs to look professional, which means one thing, to add the color. Second, I would like you to click at your data. And if you click at your data, I want you to have a right click. If you have a right click, you can put friend for that particular graph. Can Kelsey walk around from their back, see what each one is doing in class, and help them to be, all of them, into a graph? move around and see what is happening. So now I have options. I have one line to see what is happening with that particular line. That line says, if I represent proportionally all the case, this is what is going on. Can I calculate the line? I display the line equation. Can I put what is the R square? I put it, and I have it here. I take this piece of information, and I would make it larger, so I can see it. And I have this as my line information. Line means what? Means two things. What the line is telling me. It tells me two pieces of information. One is what is the intercept of that particular line when I go on and see the intercept from 0 point. That means that the line starts from a negative intercept from that particular point. That's not the most important. The most important is what is the slope. And the slope of the line says that is 0.04. At that particular case, I would like to know, at that particular case, I would like to know what does this mean. And I want to write on that. I take it and I put it down here, so I can write it. And if I want to write it, I want to put the same color here, so I can see it and not have any problem. I want to write it. The line here is in dollars or in cents or in percentages. Therefore, it tells me what is the information that I have, which means what is the interpretation of 0.04? What is the meaning of 0.04? Is this a dollar or a percentage? Is this a dollar or a percentage?
$1.
It's a dollar.
That's why
Which means if here it's $1, it's $1.
zero.
Now it's having 0.04, that means
$4.
4 cents. If I have a line, it says from one period to the other period, the line increases from one period to the other period. The line is increasing by 4 cents. Clear? The line is going up. Is this the only option I have? Is this the only option I have? No. What do? I take it and I want to be productive and efficient and effective. Productive means what? I do a lot of things in a short period of time. Efficient means what? I do it the right way. Effective means what? I do the right thing. So, do I do things again and again? Or do I take it, I copy it, I go further down, and I paste it. And if I paste it, I have another line. I have another graph. It's the same graph. But now I want my trend line to be different. I want to do a moving average. As I do a moving average, I want to do a moving average for a given period. How many working days I have a week?
5 or 6.
I can make it as many working days I have a week. Or I would leave it here, and I will take my data, and I will put a trending line. I want to moving average, and I would like to see how many days I have in a month. What's happening here? I go and do 30, which means I look at it at the monthly case, and I have two other options. I can have the lines, and I can be able to see what is happening in that case. I have two moving average, one for 5 days, the other for 30 days. Why do I want to do that? I look at the same stuff in the Wall Street Journal, the printed version. It tells me what is happening for the last period if the market moves up. And what do I see? The market moves up. The market moves up. Moving average can be used as a tool to get a prediction for the different periods, and it's not that difficult to be able to do it. How do I calculate the moving average? This moving average is moving average for 5 days. How do I calculate it? I take 1, 2, 3, 4, 5 days. I find out what is the average for these 5 days. The average for these 5 days is this one. Then I have to move. But how do I move? I drop 1 day, and I get another day here. Again, I have 5 days average. But as I drop 1 day and I get another day, you see the average, the trend is moving down. It's moving down. I drop 1 day, I get another day. I get another average here. But as the markets start moving up, the prices are moving up, the moving average also start to move up. And this is the way I have two alternatives. We can talk about the other, but let's go to the line. We said for the line, an important point is to understand what is my slope. My slope is in that particular way that the vertical axis gives me the information. If the vertical axis gives me information in percentages, I have it in percentages. If the vertical axis gives me information in dollars, I have it in dollars. Then I want to know what is the meaning of R squared. R squared is telling me that if I have a line, straight line, and things are above and below the line, how good the line is to give me information about my data. If R squared is close to 100%, then the data are very close to the line. If R squared is smaller than 100%, then means that if the R squared is 75%, I do not have knowledge of 25% of the data fluctuation. Is this good or bad? It's not that bad, it's not that good. It's somewhere in between. But if the R squared is very low, that means that the line doesn't mean anything to me. If the R squared is very high, 90–95%, this means that I will pay attention to the line. If I pay attention to the line, then the question is, what is the average increase? The average increase here is 4 cents. But 4 cents, when you know 75% and you don't know 25%. Can I go on and do something more? I'll take the line and I can see for all of my data. I can be able to do exactly the same line, having less data. And one way to do it is to make adjustments here. And now I have a different line for different time period. What is the line here? What is the line? What is the line? Is positive or it's negative?
Negative.
The line here is negative. What the line says? What the line says?
The prices are going down.
What the line says? The line says that I know only 6% out of the fluctuation. Is this line valid to tell me anything?
No.
Does it tell me anything? It says that on the average I lose 1 cent, but the fluctuation is so much that I don't want to pay attention to that particular line. And I get something that is important. What is the important point? The important point is that this line is meaningless. Why it's meaningless? Because I don't have enough data. If I go on and take more data, I do a better job in terms of that particular line. I take the graphs, I cut them off, I put them with all of my graphs so I can be able to specify what these graphs would tell me. And I go back to my data. What did I say? This is a closing price in terms of dollars. I want to go on and compare these 2 days so I can see what is happening. I want to compare these 2 days. From the 19 to 20, what's happening to the price from the 19 to 20?
It went down.
What happened to the price from 19 to 20? Went up or down?
No.
The price went down. What happened the price from 21st to 22nd?
Down a little bit.
From 21st to 22nd,
Went up.
the price went up. Therefore, I want to take a pair between 2 prices and I want to compare from one day to the other day. And I want to do it in 2 steps. The book does it all at once. I want to do it in 1 step. I want to take the price of the 20 and to compare it to the price of the 19. The price went down. If the price went down, then the price may go up. What happened in one case? The price went down 40 cents. The price went up 18 cents. Is this clear? And then I want to do something else. I want to see how much the price went down or up, and I want to compare it with the previous day of the price. This case, what I have is information in terms of a percentage. And I know how much the price went up or down as a percentage. In other words, 2 equivalent way of seeing a price movement. One in percentages and the other in dollars. 40 cents down, is equivalent to decline of 1.13 points. What do I want to do? I want to take all that information and put it for all of my data. And if I have all that information I put for all of my data, I can be able to graph things. What do I want to graph? I'll take the date. I'll take the closing price. But I will take the closing price as a percent change from one date to the other date. I take that information and I see it for all of my data. What do I do here? I take the information and I want to graph it. Now I will graph the closing price as the way I did it before. But now I have a different view. Now I know how the price goes up and down in percentage terms. And I want to use both pieces of information so I will make sense what is happening. Here is what is happening with my price. What do I need to pay attention here? If the price doesn't change, then I'm staying on the line here. 0% change means that the price does not change. If the price moves up, it's positive. If the price moves down, it's negative. What do I want to see? I want to see when the price moved up the highest point. The price moved up the highest point the 28th of October. The other day that the price moved up, the highest point is the 9th of September. How much the price moved up or down for that particular days? I can see it whenever I want here. I take it. This is one point that I spotted. The other point that I spotted is when is the highest price. How can I find it? Easy and fast. I go here and I want to find extreme points. If I want the maximum, I want that particular area to 65 to give me the maximum change. If I want to find out the minimum for all these areas, this is what's the minimum change. And I have two important points. The highest change is the increase. The lowest change is the decline. And I can be able to find out when I have the highest increase and the lowest decline. If I have the data here, I can be able to see what is happening with the price. I can use find, or I can look at my data. If I don't have that much data, I can go on and see what is happening here. This is the day that I have the highest price increase. That is the price increase that I went up for $1.50 to 58 cents. This is the increase that I have. It went up $1.58. That increase is equivalent to 4.8%. And I know that the prices are going up and down, the time is up, and I need to go on and continue on Wednesday. Wednesday, I'm going on to continue for something that if you have done statistics before, I want you to review it. I want to find out what is the average, what is the standard deviation, and then if I want to look for two different prices, I want to find out what is the covariance and what is the correlation between prices. If you haven't done statistics before, we're going to do it first time in class. And this is the way we will go on to analyze how to perform stock analysis and portfolio, which means what? I have more than 2 stocks. And why do I have more than 2 stocks? Because if I lose from one, I want to gain from the other. And I want to know how that can be done.